How are you doing? This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options training program. And what we're really quickly going to go into is Market Mondays for 5/3/2021. So we're getting the start of May. We want to kind of see how the market started off this May, the first Monday or the first market open of this month on a Monday. And one of the reasons why we do Market Mondays is this is the first time you're here, is we want to give you a really succinct, concise market-based discussion. We don't want to hold you a long time, but we want to give you a really good overall view of the market, where we think we're going to go, give you a topic to consider, give you some companies to look at, and to really get you to understand that you don't have to be a person with a degree in finance. You don't have to be a person with a degree in economics. You don't have to be a person with a degree in business. You also don't have to be one of the people, on CNBC with the suits. You don't have to be like Warren Buffett, one of the old white guys with a suit, to really be able to benefit from the markets. Because what we're going to talk about is there are marketplaces going on all around us, but however, we don't necessarily see them. So what we want to do is really try to get you involved in the markets, get you to understand the benefit of the markets and how they can help you get the life that you desire. And then we also hope that you take this conversation and you carry it on to your day-to-day activities and the kind of people that you talk to on a day-to-day basis. What I really want to ask you to do is like, share, subscribe. If you haven't subbed already, hit me with a sub. If you haven't liked the video, please like the video. Take it 30 seconds. And also share the video out if you're inclined to do so. Let's go ahead and get into it. So the NASDAQ down around 0.48%. S&P 500 up around 0.27%. Dow up around 0.70%. Really wasn't a bad open today. The market really wasn't that bad. It was kind of choppy. Kind of got a little bit better as the day went on, even though the NASDAQ did close red. We saw the 10-year treasury at around 1.59. So that's kind of low compared to what we've been seeing. What we really want to look for is Friday's April non-farm payroll numbers, right? That's going to be a good macro indicator. And if you notice, and I wanted you to look at this week, take a look at a lot of your fast food restaurants, quick serve restaurants, and the ones in the area that I'm in, they are doing signing bonuses. And what I think that you're going to see with so much liquidity in the market, a lot of people are having access to unemployment dollars. A lot of people are having access to other forms of some type of cash payment. It may be difficult to get people to work a lot of the lower paying jobs that they might have been working before, where they didn't have access to these cash payments, where they might be more inclined. So what I want to see is from a employment standpoint, if the unemployment rate is going down, however, we're trying to start to recover, what are employers going to have to do to incentivize people to come work their job? And I think that's going to be very interesting. So what we're going to look for Friday's April non-farm payroll numbers to try to figure out, one, is unemployment going down, but also, what do we think is going to happen to this new employment environment? Because what I think that we're seeing is that a lot of employers are going to find it more and more difficult to get people to take jobs that they may have previously been taking, because of how flush the economy is with money. And I keep telling people over and over again, there's a massive amount of liquidity in the economy right now, and you got to try to figure out how to get a piece of it, because there's a lot of opportunities for you to do it, and a lot of opportunities for you to do it and not worry about having to get in trouble from law enforcement. But you got to really sit down and focus on how to do it. Now let's look at the jump outs. So what we're going to do with the jump outs is kind of talk about some companies that might have performed well today, might have performed bad today, and kind of give you some context. What we saw was a analyst came out and gave an upgrade on two of the what I call logistics companies. And one of them was UPS. The other one was going to be FedEx. And as a result of that information coming out, UPS gapped up. It closed up around 4%. And we see that it came out really strong, and just essentially traded horizontal the rest of the day. But it gapped up at the open, continued to build up some momentum, and it traded horizontal. Looking at FedEx, right? FedEx gapped up, came out really strong, and it traded horizontal the rest of the day, but it traded way higher than its open. Up almost around 4.9%, almost 5%. We want to continue to observe these. This is not investment advice. I'm not an investment advisor. I'm still bearish on FedEx long term. I think they're in a very vulnerable position as a company. However, we want to kind of see that upgrade and what it may do as they start to go into their next earnings. Because on the last earnings for FedEx, even though their earnings was really good, they had a lot of selling off. And UPS had a really good earnings. So what we want to kind of observe is, as we start to recover more and more, can FedEx and UPS protect their business, or are they going to lose that business to their biggest competitor, which is primarily going to be Amazon? And a lot of times the analysts will give out an upgrade and it can cause a move in the share price. However, what we want to ask ourselves is that, what is the reason for the upgrade? Can analysts explain the upgrade? Because even though we see it and it is reflected on the chart, is this going to be sustainable? Because what we don't see, and if we're looking at both the charts, it came out and it traded horizontal. We didn't see it coming out and continue to move up. So it gapped up on the open, but then it started trade horizontal. Same thing here. It gapped up on the open and started trade horizontal. So what we didn't see was it continuing to move up, up, up. So what we want to find out first is, are we going to fill that gap in, right? Because what $14 for FedEx is that gap going to be filled in going down, but it also, where does it trade from here? Because now we're at 304. So if you look at the 52-week high from FedEx, is it 304? How far away from it, that 52-week high, is it? Is it over the 52-week high? And then does the market continue to believe that FedEx should trade at these higher prices? Now we're looking at Zoom. Now I'm showing you a 1 year chart, not the 1 day, but I want to show you something. So Zoom was down 1.7%, almost 2%. This one, the companies that I really went in depth on people buying the dip. And if you bought the dip on Zoom at 550, you just kept losing money. So if you bought at 560, you're, well underwater what you originally bought in. But I guess you just keep buying the dip. I mean, I don't know. You see, because Zoom from November, around mid-October, early November of 2020 was around 560, and it's just sold off since then. And pretty much every buy-in has gotten sold off, right? Pretty much every buy-in of Zoom has gotten sold off really, really hard. So Zoom now closed at 313. I think Zoom continues to sell off because I told people that I thought the support, we are in an era of consolidation over the past month and a half, at around 313 and maybe 320. But I thought a lot of the really strong support was around that 250, 240 a price point. So what we're seeing is that Zoom has consolidated over the past month and a half, maybe 2 months. We want to observe this to see, is it getting ready to move down? They have earnings in the later part of May. And what did they do after their last earnings? They reported really well. They put out really good guidance, and then they sold off really, really hard, right? So that's kind of something that we want to observe for Zoom. Are they going to have ability to consolidate? Do they have the ability to move up off this price point? Or do they just continue to sell off? Now, what we want to talk about is the topic of the day. And this is something that we did back when I was in business school, was that we did something called case studies. And what they would do is give you a scenario as a business owner or as a manager of a business. And they kind of ask you, how would you work your way through it? So how would you be able to fix this problem or remedy this problem or create some type of plan that we believe can work through this problem? And then also it could be like a long-term case study where you have to iterate it. So one of the things that we have that is presented a lot of us are like quick fix solutions. So, here's how we fix this solution. Well, you just do this. The problem is that iteration isn't based on a fast solution. It's based on creating a plan, creating a strategy, and they continue to roll it out over time, and then continue to process optimize it, or process improvement. So we want to understand why business case studies are important, because as an investor, long-term, and even as a trader, but really as a long-term investor, if you're investing in individualized companies, right? So not ETFs, but individual companies, you want to start asking yourself, how would you solve some of the problems engaged in a company? Because you want to start thinking like the persons whose job it is to solve the particular problem. So let's say this particular area. You are a Home Depot or Lowe's. And we're seeing that lumber is very, very expensive now. And the reason why lumber is expensive is because the production of lumber was curtailed because of COVID. Then you had a massive amount of liquidity coming to the market. As a result, it became very, very easy to buy a house because the interest rates are very low. So the home market heated up, which means what? The builders started going to work, right? Once that surplus of lumber was exhausted, now you didn't have a production that can match the demand, which therefore caused the price to go up. So it's just a basic supply and demand graph. So I was reading something, they're saying that our production, we had, I think, a housing boom in 2006. We are almost at that same number of houses being built, but we're 16% under lumber production based on that particular year. So in 2006, we were building around the same amount of homes, but the production of lumber was 16% higher than what it currently is right now today. So the question is the lumber market going to ever be able to catch up with demand? And so what happens is now that price gets applied to everybody. Well, eventually what it does is it hits the consumer. But what we're seeing is that even with higher prices, and builders were saying this, even with higher prices on building, the consumer didn't care as a result of the higher lumber. So even though the builders were saying, okay, we got to roll this price on to the consumers because lumber is more expensive, the consumer didn't care because why? The interest rate is so low. It's so cheap to get a house built now. It's so easy to get the loan, to get the financing. So then the question is, how do you manage this particular scenario? Let's say you are the CEO of Lowe's or the CEO of Home Depot. How do you manage a scenario? Because it could become an issue where it doesn't matter what you're willing to pay to get the lumber. There may just not be enough inventory, period, from a production standpoint. Because how long is it going to take production to meet demand? We're also seeing that the futures market for lumber is really, really hot right now. I didn't even know there was a futures market for lumber, but there is. So the question you want to start asking yourself is, when you see that a particular business is faced with a problem, if you were in the position of the manager or the CEO, how would you solve it? And one thing can really benefit you is from having these type of conversations. So you can sit down with your family and ask yourself, how would you solve this particular type of problem? I've been telling people this for years. A lot of times we criticize the people in positions of power, but we never ask ourselves, if we were in those positions, what would we do? Because we haven't really been assigned to make those kind of decisions. The only way that you're going to ever condition and socialize your group to make these type of decisions is start putting them in these type of scenarios where they have to make the decision. Essentially, you create like a mock scenario. So this is something that a lot of business schools do, is they put people in these positions and they ask them, okay, how would you manage this project? Because the average person has never managed a project before outside of what they do in their day-to-day activity, and they don't see it as a project. And they're really, a lot of people are really not good at it, right? Because they don't really kind of understand the seriousness of it. So one of the ways in which you can become a better long-term investor is to understand, if you was in this position, what would you do? And this is something I'm going to talk about probably later this week, that if I was a CEO of Nikola, however you pronounce it, what would I do based on what they're currently facing? And I think these can be really, really fun exercises because it gets you to kind of project and forecast and think big picture and then be able to come micro. But if you're invested in individualized companies, you want to kind of start asking yourself, what would this particular manager or CEO or owner of the company do when faced with this particular situation? Because maybe you could kind of see some parallels in what you think they would do and what you would do, and then vice versa. And it can give you a little bit more insight on what direction you think that particular company is going to go. And it can get you to kind of better understand business, right? Because this issue with lumber is a market-based, business-based scenario. A lot of people are trying to talk about conspiracies. I don't see the conspiracy behind it. It's a supply and demand issue, right? There's more demand than supply, so therefore the price has to go up, right? There's really no way around that. So once you start to really understand, the macroeconomic implications, the microeconomic implications, the business implications, you can see everything comprehensively. Then when you start looking at individualized companies, it can help you from an investor standpoint, and also as a trader. Where do you think the market may move as a result of it being a shortage of lumber? So that's going to be Market Mondays for, I think it's 5/3/2021. If you have any questions, hit me up in the comments. If you want to learn more about the highest paid part-time job in the world options trading program and how you're able to utilize your understanding of the market to drive more income into your particular situation, to get rid of income instability, to understand how to leverage the market to drive more income into your family and also potentially build wealth, reach out to me. It's going to be for serious people only. If you have any questions, let me know. This is David W. Williams, also known as Diamond Dave, and I'll talk to you later.